Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you today?
I'm doing well. Something I always wanted to ask you about, and I'm glad to get the opportunity to do it today, is when I help people understand residential property, I tell them their first step is get a buy box, right? Get a tight set of criteria so that you can look at it every day and see how the market is changing. That works in residential where you always have more and more people listing and selling and taking stuff off. I'm not sure if that really works the same way in larger multifamily. So I just wanted to ask you, how do you help? And I'm sure this is in your coaching program. How do you help people with that initial criteria search? Where do you tell them to go? What is your buy box? How do you kind of coach people up there?
So, are you talking about just the properties themselves or the markets, or what is it that you're asking?
Yeah. So for example, a buy box that I had. So first off, you pick a zip code inside a city. So 93703, just to walk people through my original buy box. Then I picked single family homes. So I didn't want duplexes through fours, didn't want condos, didn't want this. Then I said 3 or 4 bedrooms, 2 baths, between 1,250 and 1,750 square feet. That was my buy box for 2.5 years. That is all I looked at. If you were in that buy box, I saw it. And if you were not, I didn't. And that allowed me to learn that very small market better than 99% of agents. And hence I was able to buy, 6, 7, 8 great deals because I found value there. That's what I mean.
So, yeah, there's definitely like a target, but I think it's a little bit harder in multifamily just because
I would think so. Yeah.
right. I mean, you can't the home, the single family home market is a lot more liquid
Mhm.
in the sense of there just being more product, right?
Yeah.
So you can have a buy box in multifamily, but if your buy box is too tight, you just won't get anything, right?
Totally agree. Yep.
So you need to have a little bit more flexibility around it. Generally, what I'm looking for is, uh, and this has changed too as the market has changed, but
Mhm.
generally speaking, well, where I started out was looking for 100+ unit deals,
Okay.
right, that were under $10 million. I was
Okay.
not looking for light rehab, no heavy repositioning, right? In markets that were growing fast and in good school districts, and that was kind of like the box, right? And um, over time, so that included like B and C property. It was bigger.
Okay.
Over time, I have, through experience, learned that I'm not really a big fan of C properties
Okay.
because your rent collections are hard. Your yields look better going in, but then collecting the rent is an issue.
Yeah. Real life doesn't fit in Excel.
So, uh, so now I am much more focused on uh, B properties.
Mm. Okay.
They have a stronger tenant base, much more recession resistant,
Mm.
right? And
Yes.
because if you're dealing with a primarily white collar or more highly skilled blue collar tenant base, when a recession hits, companies don't want to lose those employees, so they'll hold them, they'll keep them on
Longer.
payroll
Yeah.
even when things are going bad because they know when things come back they need those employees, right?
Mhm.
So,
Mhm.
so that it's much more stable, and some of them aren't affected by the economy at all, right?
Yeah.
So I prefer B properties, and the unit size, I've become more flexible about that just because prices have, you can't used to be able to buy 100 units
Mm.
for under $10 million, and now it's become very difficult, right? If you want to buy B property, right? Because
Right.
now, your per door price is over $100,000 in most markets, right?
Yeah.
And,
Many markets, C-class properties are over 100K a
oh
door.
yeah, yeah. I mean, and look, when I started buying, I thought 40,000 a door was ridiculous. Like I'm not paying 40,000 a door, right? And then, so here we are at over $100,000
Right.
a door. As for why, check into our last conversation about the Fed, but
Yeah. Exactly.
but that's where we are. So, one of the reasons for focusing on 100 unit properties before was the quality of management that you could get for
Mhm.
those properties. Um, Now with smaller properties trading for much higher, uh, prices and rents being much higher, like your income from those properties is also much higher. you can actually afford better management for smaller properties because the like the dollar amount that you're getting for it is more. So it becomes more cost effective to have, high quality management on those properties.
Gotcha.
I also, I have become less focused on fast growing markets.
Okay.
Because one of the things I realized was that there is pretty much a housing crisis in every market in the United States, whether they're growing fast or not. And the slow growing markets don't have as much construction, right? So the fast growing markets have lots of construction. They can't keep up, but still there's a lot of, they're still keeping like the failing behind. But in the slower growing markets, the same thing is happening. There's less construction.
Interesting. Yeah, that's an interesting point. Because again, if you look at kind of, I think it's Ivy Zellman, if you look at the cities or regions that might overbuild, it would be the high growth areas, right? Those are the ones that are most likely to overbuild because it takes a lot of time to, take something out of the ground, if you will. The slow moving markets, they're just not building. So the chances of overbuilding are nil, really.
Yeah. I mean, there's construction going on, but it just is not at the same pace, right? And one of the differences too, a lot of the more slowly growing markets are places where there's just not much land left to build on, right? True. So that's part of the reason why they're slow growing. Like the housing stock, it has become basically saturated. Like the land has become saturated. Zoning prevents much housing from being built. Prices have gone up a lot and people are being priced out and they're moving to these other areas. They're moving to the high growth areas because of exactly this issue. So they're related to each other, right?
Yeah.
The slow growing areas are causing the fast growing areas to be faster growing because of the price of housing, right? So all these markets are connected to each other in one way or another. And this dynamic of there not being enough housing is consistent pretty much everywhere. So some markets that are growing slowly, but still growing are places that I look at now as well. And there's a little bit less investor competition in some of those markets. The cap rates are not that much better, to be honest, because it has become a national market. Sellers know that their competition, like a seller, I was up last week looking at a property about 50 miles north of New York City. The seller on that property knows that his buyer base is like looking at deals in Dallas and stuff too, right? Like they know that it's basically cap rates are kind of compressed together all over the whole country. However, there's a little bit less competition in markets like that. So, which means that your chances of getting a deal are better. So
I like it.
Yeah. And then the other thing is I used to be very, very strict about having like an 8% cap rate and stuff like that. Right. And I used to tell people like, this is what you should be aiming at. The problem is it's just not realistic anymore. Right. Yeah. I mean, it's highly disciplined, but if you're so highly disciplined that you can never buy a deal, it doesn't make sense. Right. And I never thought that the market would be where it is now because we've never had a market like this before. We've never had this kind of cap rate compression ever. Right. But it's a different world. And I hate to say it because this time is different is one of the most dangerous phases.
That's dangerous. Yeah.
However, look, there are some differences now. Things have changed, right? Doesn't mean that I think that this time is different usually is brought up in the business cycle is over. Like we fixed the business cycle. There can't be a crash. Like that's the dangerous way of saying, of using that phrase, but saying like, this time is different, meaning like, prices have changed in a way that we've never seen before. Right. It is different. Right. So you have to be thinking about things in a little bit different way. And I think another way that my thinking has changed is I've become a lot more defensive than I used to when I buy. Okay. So I used to think more about like how much money can I make on this. Now I think about, all right,
protecting the downside.
I mean, I was always concerned about preserving investor capital and whatnot, but I mean, now it's really a concern where you have to be thinking about, okay, like what's going to happen, like to this deal if things go south? Like how much occupancy can I lose? How likely do I think I am to lose it? Right, those sorts of things. So, you have to be thinking about those things too, especially when you're going in at such low yields. There's just very little room for error.
Yeah.
So far, the market keeps on bailing itself out, and with these high occupancies and enormous rent increases and stuff.
Yeah.
It's continued to just kind of chug along without these issues coming up. But I mean, at some point this will end, right? So you just want to make sure that when that happens, you're prepared for it.
Yeah. So kind of two questions I want to dig into. One, you talked earlier in your original buy box about good school districts. Is there a site that you go to, and I don't know if they rank them by test scores, or what is a good school district mean, or how do you look?
Yeah, I mean, like there's niche.com, there's greatschools.com.
Okay.
And you can just they literally rank them on a 1 to 10 scale, right? And I think it's also helpful to talk to people. Like if you talk with brokers, I mean, you can find out which are the good school districts.
Okay.
And what I have found is that rentals in good school districts outperform other rentals in bad school districts, right? Because you attract a better, you just attract a better tenant base, right? Even at any level, even if it's like a C property, your C property in that good school district is going to outperform a C property in a bad school district.
Agreed.
You just have the people who are there want to be there because the schools.
Yeah, they pick it on purpose many times.
They're not there accidentally, right? And so those people are going to keep paying the rent because they're serious about their kids' education, and so it's that's one reason why I like those schools. Another thing that I like too, I didn't mention this, is because we were really talking about the property buy box, not the market.
Okay.
But I just really like what I call anchors. Anchors are things that are not affected by the economy. So like a state government, not going anywhere. Right. Even if they have budget cuts, it's always at the margins, right? They're not halving the size of the state government, right? Maybe they're going to do 5% budget cut, right? So that's pretty much immune to what's going on in the economy. Major universities, like big universities, the same thing, right? They will just keep on chugging along, and really the economy will not be affected that much if your market is anchored by a major university. Major hospitals, like if you have one of those huge like hospital complexes, right, where those are not affected by the economy. Major distribution hubs, right, they're a little bit more subject to the economy, but when you've got these like nodal places, anytime you've got like a node where you've got like goods being transferred from one form of transportation to another, like ship to train, train to truck, right? Those kinds of infrastructure take years, if not decades, to build, and once they're built, they don't move. Right?
Not going to move.
So they're not going to move them. They can't move them, right? So you cannot export that. You can manufacture 100% of everything in China, but if you're going to sell any of it in the U.S., you need a place to distribute it. And so those things are really good anchors, and they tend to really logistics clusters is what they're called, right? Okay. So logistic clusters, if your local economy is based on a logistics cluster, like buy right next to that cluster, because those jobs are just gonna
not go anywhere.
I mean, like I said, at the margins,
of course,
you have some variation, but it's not like investing next to like a GM plant, right? And then GM closes the plant, or even like investing next to a military base,
right?
Because the U.S. could just decide to close that military base. Like that logistics hub is not going anywhere, right? So
I like it. I like it. The last question I have for you, and it's really about, we kind of hit on the fact that cap rates have been compressed like no other time. In your history, or in your experience, or maybe you've read about, have we seen cap rates go the other way? And if they have, what's kind of the track record for, how bad could it get? Right now we're talking 3s and 4s. What happens if it goes the other way?
Well, I mean, listen, it has. In the great financial crisis, it did. And typically it does. I mean, cap rate compression and decompression is a normal part of the real estate cycle, right?
Okay.
Now, you may not have wild swings, but you definitely have loosening and tightening that, and it depends on the availability of money, right?
Okay.
So it doesn't, there's not a one-to-one correlation with interest rates, but there is definitely a relationship between interest rates and cap rates. And the available, the more money is out there, the more people are going to be chasing deals, and the lower cap rates are going to go. And then when people stop chasing deals, then the same thing happens. There's still deals that need to be sold, right? People die.
Yeah.
People need to refinance. People don't want to do it anymore.
Right.
Things happen. So there's still deals happening, but
For sure.
when people are scared, then you have to keep on discounting your price to get a sale, right? So that'll push cap rates up, and that's what happens, right? So when I started buying, it was a couple of years after the financial crisis. I'd already, frankly, at the time, thought I missed my big chance, because when I was hearing stories about what happened, like what people were buying in 2009, just like insane pricing that they were getting. But even in 2011, I mean, the reason my buy box started out at an 8 cap was because I could easily get an 8 cap. Right? Like, why would you pay more than an 8 cap, right, for something? So because you could get 8 caps, and like if you were looking at a C property in a tertiary market, you're looking at 10 caps, right? So it expands and contracts. And I think people who are really sophisticated, who understand sort of where in the cycle they're buying, if they're buying at the beginning of the cycle and they're buying at a higher cap rate, it's standard underwriting, you always want to exit it. You always want to underwrite to a higher cap rate, right? Because you want to be conservative, right? But you may have a scenario if you're buying, if it's the beginning of the cycle, right? You know that there's going to be cap rate compression over the cycle. So you want to scenario plan that out and see, like, well, cap rates could go down, right? And I believe they will. And I wouldn't tell my investors that, but like, I believe they will go down. I think this is our potential upside. But I've heard people doing that now who say cap rates are going to continue to go down. It's insane.
I heard one he's a syndicator, talk about he thinks cap rates are going to 2.5. I'm like, what?
Not with rising interest rates.
Logically, it can.
Listen, we could have a whole other conversation about sort of negative leverage and what that does, but
don't do it.
If the treasury is at 275, right, and you have a spread on top of that from banks, like people are basically saying like, hey, I want this deal so badly that I'm willing to make less money by putting debt on it, than by buying it all cash. It doesn't make any sense to me. So I mean, there have been times of negative leverage in the history, but they don't last very long, right? So
this again, folks, is an area I do not play in. That's why Jonathan's an expert. If you want to play in the big multifamily space, you got to follow Jonathan. How do you want them to do that?
Yeah, so the easiest thing to do is go and join my free Facebook group, Multifamily Investment Community. Just join the community and come be part of the conversation. Ask all the questions you want. I'm happy to answer them. You can also, if you want sort of more attention, you can join my coaching program, multifamilylaunchpad.org/join. All the details are there. You will find it surprisingly affordable. And if you would like to join my investor list, you must be accredited, but if you are accredited, you can Google Two Bridges Asset Management LLC and fill out the investor form. We actually do have some deals in the works. So come and join us and get in on it.
Awesome. Thank you very much, Jonathan. Been a great week.
Absolutely. You too.